Hey, are you familiar with your employees' benefits? And especially if you're working with the governments or the big companies, do you understand what kind of retirement plans you have? Over 4.3 million Canadians were covered by a defined benefit pension plan in 2019. And if you're part of the 4.3 million, do you know what you get upon retirement? So in this video, I'm going to help you understand more about your company pension plan. For example, what affects your pension benefits? Will your spouse or your beneficiary able to keep your pension plan if you pass away? Or what happens if you quit your job? Can you move your pension over? I will go over all the questions above so you know exactly how that contributes to your overall retirement plan. And hey, welcome back. This is Thomas, here to help Canadians make better choices on retirement, wealth, and insurance. My goal is to make sure you take home one or two ideas and start making better financial decisions today. If you find this video valuable, please consider subscribing so you'll never miss any of my videos. Now let's get started. In Canada, there are two types of employer-sponsored pension plans. First one we have is the Defined Contribution Pension Plan. This plan is where you know how much you pay into the plan, you have a freedom of choice on where you want to invest, but the result is not guaranteed. Compared to the other one, the Defined Benefit Pension Plan, which is what we focus on today, as the name suggested, your pension payout is guaranteed. You know exactly how much you're going to get per month during your retirement. Now, how does it work? Well, most of the time, you and your employer will contribute to the plan together, and the pension plan administrator invests and manages the fund. The longer you stay in the company and the higher income you are, the higher the pension payout. And even though you don't have a say where you want to invest this money, no matter the market goes up or down in the next 30 years, you are guaranteed with a fixed retirement payout. And that's why when I was young, my parents always wanted me to work with big corporations or the government. Anyway, there are a few flags to be aware of when you have a defined benefit pension plan. First of all, most of these plans are not indexed payout. An index plan is where the amount you get might increase on a regular basis, with the intention to help you cover your living expenses when the overall cost of living increases. But as I said, only a handful of pension plans are indexed. So if you're planning to retire early, then you need to make sure you don't just rely on this income source. And speaking of early retirement, the earliest you can access the pension package is at age 55. And if you do retire between 55 years old and 65 years old, in addition to your pension income, you'll receive a bridge benefit that is payable from your early retirement dates until 65. Because by age 65, you should be receiving CPP and OAS as well. So again, if you choose to start withdrawing at age 55, you will get a bit more. Then by age 65, the pension payout will be reduced. There's a whole bunch of calculation to calculate the bridge benefits and the actual amount you're gonna get. But I think the easier way is to talk to the HR department, and usually by 54, they will send you a statement to give you an update. Alright, next, let's talk about what happens when you choose to retire then. It depends on the provider, but normally you have two options for your benefits. You can either opt in for a single person payout, or you can do a joint payment. With a single person payout, the plan only pays you and you only, meaning if you pass away, unfortunately, your spouse will not get any payments, and all the money is left over will go back to the plan. With a joint payment, on the other hand, you will get less retirement payouts, but your spouse will be entitled to get your benefit when you pass away. The less you get for your pension payout, the more benefits your spouse will get when you pass away. And here's an example. Say John works in a bank for many years and now he wants to retire. In the pension package, he has a couple options. If he's single, he has two choices. Option A, payable to John only for John's life, but in the event of John's death, his pension payment will cease. Or option B, payable to John for the next 10 years. If John passes away within those 10 years, the remaining will pay to John's beneficiary. But if John is still alive after 10 years, then the pension payment will be reduced. Now, what if John is married? Then he has another two choices. First option, he gets 100% of the benefits, but if he passes away, the surviving spouse will get 50% of the payout only. Or second option, he gets 90% and the spouse get 90% as well. Notice that in these scenarios, if both John and the spouse pass away, or if the spouse passes away first, then all the remaining benefits will go back to the plan provider. This is extremely important, and make sure you triple check your pension package as each carrier has different terms. Now you may ask, what happens if I quit the company then? If you quit, there are a couple of options that you can do. You can choose to leave the plan there and let it grow. You don't touch it until the day that you're retired and get a payout by then. However, usually the payout will be extremely small. Or you can also transfer it to a new pension plan, but only if the new company has a pension plan as well. Or the last option is you can transfer it to your own LIRA, which is Lock-in Registered Account. As the name suggested, this account is locked in and you cannot touch this money until you reach age of 55 or unless you are in a financial hardship or severe disability. Once you switch to a LIRA account, you have the ability to choose your own investments. So therefore, if planned and done right, you should have a higher return compared to a traditional pension plan. And also, for most of the LIRA account out there, you can name a beneficiary, which means for sure your hard-earned money will only stay within your family. But let's talk about the downside of a LIRA account then. Similar to RSP and RIF, by age 71, you need to convert to LIF accounts, short for Life Income Fund. And the biggest difference between LIF and RSP, where RSP or RIF, you can choose to take the whole amount out if you want to. Versus for LIF, it has a maximum annual withdrawal limit based on the province that you're in. So say if you have an emergency and you need money, you cannot take more from the LIF account. And lastly, since you choose your own investment vehicle in the LIRA, then you are responsible for your own risk. And something to keep in mind about pension transfer to LIRA is not a complete dollar-to-dollar transfer like tax-free saving or RSP transfer where there's no tax implication. If you do want to initiate the transfer, usually the pension provider will let you transfer 80 to 90% into your LIRA account. But the remaining 10 to 20% will be paid to you in cash, and that will be counted towards your income for that year. And sometimes this is a good way because now you can access some of the money to pay off debts or invest it in other areas. And if you have enough RSP room, then you can put that cash in there to fully offset it. Lastly, what happens to my pension plan if I die before retirement? If you are not eligible to retire at the time of death, then your spouse will be entitled to the commuted value of your retirement income, which is a lump sum of the present value of the benefits accrued. But they will also have the following options. They can neither transfer it to the pension plan of the employers, but only if the employer agrees to accept it, or they can transfer it to a lock-in RSP or similar plan. As I mentioned before, all these plans vary by employers, so it is very important to go over your benefit package again and also speak to the HR should you have further questions. Or if you just quit your job and you still have an RSP or a pension plan with your previous employer and just not too sure what to do with it, let's have a chat. There's a link below for you to book a complimentary consultation with my team and I. We can review your plans to see if they are on track and what's the best option for you. Anyway, I hope this video has provided you with an overview of how typically a defined benefit pension plan works. And if you like this kind of content, please leave me a comment and give this video a thumbs up. It helps with the YouTube algorithm to promote to more people. This is Thomas, and I will see you in the next video.